First, we kick it off with Spot On. It's our take on the big story, and today it's oil right around $30 a barrel. I spoke to Scott Sheffield, Pioneer Resources CEO, one of the Permian pure plays, about what that means for U.S. shale companies.
I think most companies will probably go into what I call maintenance mode. They'll probably get to flat production. Very few producers are hedged going into 21, so I would expect if we see low oil prices next year that most companies will not make it. We could easily lose 2.5 million barrels a day by the end of 2021.
Joining me now is Ed Morse, Global Head of Commodity Research at Citigroup. Ed, thanks for being here.
Always a pleasure to be with you.
Does it get that bad?
Well, it could get that bad. I agree with Scott that the producers are going into maintenance mode. They're really still a function of what the price of oil is going to be. We reckon that if WTI stayed at $40 a barrel, production would eventually flatten itself out, plus or minus a little bit on the shale side. If it goes down to 35 or 30, then the numbers that Scott put on the table are exactly right. You get to 1.5 million to 2 million barrels a day of cut, similar to what happened post 2016, really.
So how do we get a bottom here in oil as we sit right at 30?
So, we've been thinking about this. In 2016, we did a piece called Oil-mageddon, and we thought through, how does the market rebalance? Eventually, all markets rebalance. So it'll be a function of supply and demand, and there'll be a little give. As Scott indicated, the U.S. as the swing supplier, in fact, has to go down to where the call on shale happens to be. And you could put in scenarios when the call on shale is where it is now. It could be a little higher, a little lower. The function of the market, the functioning of the market is a little bit more complicated than this, this thing that's going on with the coronavirus really giving us a demand shock, and the two of the three major producers going into a market share price war. We've had it before. They come to an end. They come to an end actually by logic. There's a point at which nobody wants to buy the oil. They don't want to buy it because the cost of storage is too high. They don't want to buy it because they don't need it. They don't want to, we're going to have refineries that are going to be reducing demand for oil. And sometime between now and the end of the year, this comes to an end. We think sooner rather than later.
So what we are seeing is super contango. So the months today versus, say, 12 months, 6 months out are so much cheaper, drastically cheaper than farther out. And that means that you're going to store oil now and sell it later. The rhetoric seems to be that we have a lot more storage opportunities today. So we're not going to run out, which potentially means we could still have this price war go on for a lot longer.
Well, we could go on for a lot longer. But, look at the numbers. We reckon that in the first quarter, the overhang of inventories was over, something like 2.6 million barrels a day, maybe 2.8 million barrels a day. 90 days worth of that is 240, 250 million barrels. We think the second quarter is going to be deeper. Could be a relatively lowish number, only 300 some barrels a day, but that over 90 days is another 200 and some. So we can get, in our modeling, we think there is enough storage to handle things. We only see an increase of like 435 million barrels for the year as a whole, if everything goes the way we think it is. But we could be in a situation where the overhang is something we've never seen before. It could be 2 billion barrels, and the world does not have enough inventory capacity for that. I think there's one interesting thing that could happen on inventories. We saw it happen in 2009. So it's the China-Saudi relationship. In 2009, the oil prices went down. The Saudis sold around 500,000 barrels a day for more than 4 months to China to let it fill up its strategic stockpile. So we think between the commercial and strategic stockpile capacity in China, we could have China buying actually 750,000 barrels a day for 3/4 of a year before they, run out of storage capacity. So there is some space there for some kind of deal on the horizon.
And do they just hold it, or do they make it into product and then flood the product market, which is already getting hit by the virus, and then now with this travel ban from Europe to the U.S. has really pummeled jet fuel prices as well? So how does that play out?
Well, it plays out in a kind of ugly way. So you talked about the contango, and the contango being an indication that it's usually an indication that storage is tight, and you need more expensive storage, so the prompt has to fall lower. But here we have the prompt falling lower because suppliers in the market, particularly the Saudis, have said, hey, we've got inventory and we've got production capacity, and we're going to drop the price to a discount to wherever the buyer, it's going to be so attractive that the buyer's going to line up to get the oil. So that's what's really happened, and they did line up, because when we started only last Saturday. Before last Saturday, we had Brent in backwardation, not contango. We had in the kind of oil that Saudi Arabia sells, a very high demand because OPEC Plus had taken all of the the sour crude out of the market, and all of a sudden you get sour crude, and the refiners, whether they're in the U.S. Gulf Coast or in China, some parts of Northwest Europe, they can make more money more efficiently by refining this kind of crude. So the demand for it really went up, but the price exacerbated the contango that the world market fell in.
Which is sort of music to Saudi's ears in some ways, because they get the market share and they get the volume even if they don't have the price, which leads me to the war that Russia and Saudi Arabia are waging in the oil market.
Go back to where you just were. You said what happens to the refiners. So they gobble it up because it's cheap, and then we expect demand to really fall. So in our worst case scenario, in which we have like what happened in China happening in the U.S., not out of the question, not that remote, but not a highly likely condition. China had a drop in demand of about 4 million barrels a day in the month of February. It was pretty steep. If we have a China-like phenomenon in the world outside of China, including the U.S., that would be a drop of 12 million barrels a day demand. So yeah, we have the supply overhang, but we have the demand problem. And then what is the refiner going to do? There's not going to be anyone to sell it to, and the crack spreads are going to go down, and they're going to stop wanting to buy that crude oil. So that answered that other question.
So what does that market look like?
That market looks pretty ugly for refiners in the months of April and May. And then the question is really, what does this mean for Saudi Arabia and Russia, and how do they blink? Who blinks first? And that's, I think that's the big open question at the moment.
So answer the question. So who blinks first, how, why?
Yeah, and it may be a dance. So let me walk you through the dance. I mean, the Russians and the Saudis have a lot of cash to work their way through this. We know that the Russians have started using their cash. We know that the central bank starts buying to support the ruble, because the ruble goes down when the price of oil goes down. So $42 Brent is a signal to buy oil to start using their reserves. We don't know how much they will be using, but we know this is something that the Russians are going to have to start monitoring, even if they start with more than $500 billion worth of reserves. The other thing they have to look at is who they're selling to. So I don't think they expected the Saudi response to be quite as aggressive as it turned out to be. I think they didn't expect this 12.2 or 3 million barrels a day to be supplied out of inventory and production. And the way the Saudis did it, they took it out of inventory, not just at home, but abroad, including Rotterdam. It used to be the case that the Russians had a locked-in market, but most Russian oil is sold on a spot basis, not on a long-term contract basis. The long-term contracts tend to be financial deals done in China, but the European market, the heart of Russian exports, are mostly spot sales. And the Saudis really could have hurt them in that market. So it'll be interesting to see when we look back at the end of April, how much of a market share loss there's been to the Russian producers.